the general consensus is that it's working. So if you're having some issues, it must be on your end. So I'm going to go back, and so everything that I just kind of talked about is true when we look at high price underlying, like booking holdings, which is the old price line. I'm going to grab this and we're going to go to presentation, where we have a $4,000 price on an actual stock. So in this scenario, we're going to look at the September 28th expiration, which is 8 days away. We're going to get bearish. That's why we're going to use puts. If I want to be bullish with my butterfly, I would go to the opposite side of where the underlying stock is at, and I would use calls. So in this situation, we're going to go 8 days away. And if we look at this scenario here, here is the profit and loss graph that you were just looking at inside the options playbook. And we're right here, right about where strike C is at. If you notice here, our underlying stock is at 4,047. And that would be right here. The put that we're buying is going to be 4 points below at the 40-40 strike put. And we're going to sell 2 of the 40-20 strike puts and then go down and buy the 4,000 put. Now, this is one of the things that's wonderful about a butterfly in an underlying like this, is that if you actually we want the market to go to 40-20, right? If we bought that put outright, that would cost us $34 for 8 days of time premium. We still want the market to go to that level, but if it goes to that level, we can make $20 on our trade minus $225. So now, instead of having all that risk of paying for this option contract at $34, our total risk, if we do the 1x2x1 butterfly, which we're going to send to the trading floor all as one trade, is going to be the net debit paid for this butterfly. Or this is real markets using today's numbers, that was trading at $2.25 at the midpoint today. So $225 is our max risk. Our max profit would be 20 minus that 225, or 1775, or $1,775. Now, okay, are you in your seat? Are you ready? I got to tell you something though. If you do make the maximum profit on a butterfly, you should receive the stupid award. You want to know why? Because you should have been out way before that expiration. If you get a situation where you're approaching the expiration date and the underlying stock comes down and hits your strike price and you are profitable on your trade, you should get out. So the only way that you're going to make the maximum on your trade is if you pay $0 for this $34 put option, and the only time you're going to do that is at expiration if it's right at your strike price. So once again, if I'm doing this trade, I want to dampen expectations. The profit and loss graph at expiration looks wonderful, and one of the things that I do really love about the butterfly is that this small little area, and I'm mousing on it right now, that's your maximum risk. Very little risk on the trade. That would be $2.25 above strike A or strike C and below strike A. Also on this butterfly, when you're using higher price stocks, you see that here's the actual range that the underlying can land in. It's a $35.50 range. So how do we come up with that? You actually take the strike price of the 440 put minus the net debit paid. So our break-even point on our profit and loss graph right here is going to be $4,037.75. On this one, it's going to be $4,002.25, which is this strike plus this premium. So in general, if you look at a put butterfly and you're doing it in a fairly high priced underlying, it's a very enticing trade from just looking at the profit and loss graph at expiration. But we need to dampen our expectations in that if I do this for $2.25 and I can double on the trade, let's say I can even do more. Let's say I can sell it for $5 to make the math simple. If I can sell it for $5, that's a good trade. And you should have your goals set and your expectations set that if I do double on the trade, I'm going to get out of that trade. I'm not going to hang around and try to get the maximum on the trade. So you have limited and known risk, but in order to make the maximum, as opposed to buying a put outright, right? If the market goes down, you want to get out right away on that trade. The maximum only occurs when you get closer to that expiration date. Okay, so with my butterflies, if I'm doubling on them, I'm usually going to get out of that trade. It's that simple, that straightforward. But here's the catch with me doing butterflies. Very rarely do I just do a put butterfly and do it in a standard manner, for lack of a better term. I call this a standard butterfly. But there's no rationale why this is standard except for the fact that this is the one that most people talk about all the time. The two other butterflies that I'm going to look at, I'm going to modify them, and I'm going to mess with the risk and the reward of the trade.